Actually, by describing how can M&A transactions be conducted, we can understand the responsibilities or functions of investment bank in the M&A transaction. The M&A transactions starts with developing a strategy, identifying suitable target company, performing due diligence, and negotiate on the offer, and finally integrate the target company with the acquiring company. Typically, the investment bank is involved from the beginning of this process, with a team includes geographic and industry experts, financial analysts, and M&A advisors. Developing a good merger and acquisition strategy needs a clear idea of what the acquiring company expects from making this transaction. In other words, how can its strategic business plan be accelerated or be more successful by conducting merger and acquisition transaction. So the acquiring company should have certain incentives to conduct M&A transaction, such as to expand product line or to gain access to a new market. To identify the suitable target company that could achieve the objectives of the acquiring company, the investment bank firstly assists the bidder to set search criteria such as profit margin, geographic location, customer base. Then the investment bank can look for potential targets and evaluate them. The investment bank can be delegated from the acquiring company to make contact with one or more target companies to see how willing to a merger or acquisition the target company is. Assuming initial conversations go well, the investment bank asks the target to provide substantial information such as current financials that enable the investment bank and the acquirer to further evaluate the target company. In this regard, the investment bank uses common valuation methods such as discounted free cash flow and multiples, in addition to the capital budgeting techniques such as net present value if they are needed. Once the target company accepts the initial valuation, the investment bank and the acquiring company perform what is known as due diligence. Why? To confirm or correct the acquiring company assessment of the value of the target company by conducting a detailed examination and analysis of every aspect of the target company's operations, including financial metrics, assets, liabilities, customers, HR, and others. An important task performed by investment bank when designing the merger or acquisition transaction is the choice of method of payment or consideration, and also advising on how the acquiring company can finance this transaction. The investment bank provides the acquiring company with two options to pay for the target, either to pay in cash or to issue stocks. Regarding the cash offer, the acquiring company could use its earnings or borrow money to pay for the target company in cash. Note that borrowing money to finance merger or acquisition transaction is known as leveraged buyout. Regarding the stock offer, the acquiring company will issue new stocks and exchange them for stocks of the target company in a transaction called stock swap. The investment bank advises the acquiring company on possible effects of each method on issues such as company control and earnings per share. At the end, the acquiring company and its advisor construct a reasonable offer, and on the other hand, the target company and its advisor will review this offer. Then the two parts can negotiate on terms such as method of payment, stock swap or cash, current price or negotiated price per share, non-financial issues related to the existing management, for example, and distribution of wealth between shareholders of both companies in case of merger. The merger and acquisition deal closes and the management teams of the target company and the acquiring company work together to finalize the integration process.